Good evening to our participants. So let's kick into the webinar. Yeah, so we'll start with the performance across all our funds, starting with Coffee Can. So if we look at the 1 month return, obviously it was a difficult month for large caps, where the index gave a negative return, but obviously the fund was positive. And the main contributors to that were Hitachi, Pidilite, and Asahi India. In terms of the bottom performers were State Bank of India, TCS, and Britannia Industries. Moving on to GNC, so Good and Clean has seen a very good performance not only this month, but if you look at the last 1 year performance as well, the fund has really come back very strongly. If we were to talk about this month was a positive return of about 1.7% versus benchmark remaining virtually flat. The key top performers in the fund were BHEL, Manappuram Finance, and IGI. The bottom performance were State Bank of India, City Union Bank, and Bharat Electronics. Moving on to Micro Marvels. So Micro Marvels for the month was almost sort of flattish, given that in the month of April we had delivered about 20-odd% return. Obviously, in the month of May, it was slightly flattish. But the fund has sort of recovered since the month of April, led by buoyancy in the small and the micro cap space. If we look at the top performers for the month of May were Sunstar, Moltech Packaging, Shivalik Biometals. In terms of the bottom performers were Global Spirit, Tejo Engineering, and Cantabile Retail. In terms of our Ambit pricing prowess, which is on the AIF platform, again versus the benchmark, which was negative, this portfolio delivered a positive 1.5% return. The key contributors in this fund were again Hitachi, Asian Paints, Solar Industries. And the key drivers were SBI, CRISIL, and LG Electronics. Now let's move on to the topic of the webinar, which is our newsletter. So in this newsletter, what we have done is we've covered the result performance of all our funds, starting with Coffee Can. So you can see in Coffee Can, the portfolio delivered a revenue growth in double digits of about 12%. However, the PAT growth was slightly lower versus the benchmark at 2%, primarily led by detractors like LG, ABB, and Interglobe. In a couple of companies, there was a labor code impact, as a result of which the reported profit was slightly lower. But in terms of the positive contributors in the portfolio, as far as the results is concerned, were Zomato, which is Eternal, Lupin, and Hitachi. Moving on to Good and Clean. So if we look at the Good and Clean PAT growth, it was extremely strong at north of 20% on a YOY basis in terms of profit after tax. Even the revenue growth was extremely strong at 17% YOY. If we were to talk about the key contributors to this profit growth, has been Paytm, Manappuram Finance, and MCX. And if we were to talk about the key draggers, it was Axis Bank, Canara Bank, and Timken. But more importantly, the revenue growth and the PAT growth, which has been double digit, has been very, very encouraging because people who invest in this space sort of come when the earnings growth is in high double digit, and that is what the portfolio delivered as far as the fourth quarter results is concerned. Moving on to micro marbles. So if you look at the PAT growth for the portfolio was close to 34%. If you look at the third quarter as well, the portfolio had delivered a 38% earnings growth. So the earnings growth for the portfolio continues to be fairly strong and much, much ahead as far as the relative benchmark is concerned. The key contributors to the earnings growth has been Landmark, Global Spirit, and Eveready. And if we were to talk about the key draggers were Insecticides India, Food and Khadim. So net, the conclusion from the fourth quarter results is that both the mid cap, small cap, and the micro cap strategy for Ambit continues to deliver very strong earnings growth. And this is the second consecutive quarter where the earnings growth has continued to remain extremely strong. More importantly, if we talk about the respective benchmarks as well, you could see that the earnings growth in mid cap as well as small cap continues to be very robust. And this was something which was missing for the few quarters, but since the last two quarters, across mid and small cap, the earnings growth continues to be very strong double digit. Possibly this could be the reason why since April we are seeing large caps underperforming mid caps and small caps, because generally when mid cap and small caps start reporting double digit earnings growth, then the interest comes back into this space. And we believe that FY27 could be a year where possibly mid cap and small caps could do extremely well. Obviously, Trilok will take more details as he covers the macro going forward. Over to you, Trilok.
Yeah, thank you, Bhargav, for taking us through what the portfolios and the earnings are shaping up. Now I will take you guys to what we are seeing in the market and what basically are the key intervention done by the government of India as well as the central bank. I think so. One of the big question mark on everybody's mind was how is going to how are the crude and the current the two C's, right? Crude, currency, and CAD, the three C's everybody has in mind. So everybody was questioning about or waiting for some kind of intervention by the central banker or the government of India. The good news here is India obviously lost a lot of competitiveness when if you think about the currency perspective compared to most global currencies, and we will cover this in the in the subsequent slide. But back in 2013 also we saw this kind of measures taken by the government. Obviously, at that point in time, it was an FCNR deposit raise that the government did without any swap facility. But this time, government RBI has announced a full FCNR bonds for a 3 to 5 year period. Now there are two important elements out here. One is the hedging cost will be borne by the central banker. Second, it is obviously exempted from any CRR and SLR, sort of requirements. And third, most importantly, it will obviously all these, dollar swaps will be having a 1 year lock-in. So what it does is it basically not only allows the currency to see a significant capital flows that will help the rest of the currency, but it will also strengthen the dollar sort of reserves for the country, which essentially is a very critical point given the global backdrop of crude, which went down to $100+ because of US Iran invasion. Second, also with respect to external tariff, which is whether it's US or Europe, leading to some loss of businesses in the for the exporters. And finally, and most importantly, the big narrative of AI and ensuring the job losses in the country and subsequently lower export from the IT services. Subsequent to this announcement, we have also seen the government also announced an FII exemption on capital gain tax and interest rate on GSEC. particularly the government securities, effective from 1st April 2026. Our understanding is not only will this be a very, very strong measure, but we will see a lot of capital flows because of these two measures, and we will cover this in the subsequent slide. Moving to next, if you look at the number, right? So our sense is between 50 and 80 billion dollar is what you will see the number flowing in the country only because of the FCNR deposit that the central banker has announced in the last few days. Moreover, whatever we are learning and picking from the ground, whether it's ICICI or private banks or large PSU banks, or for that matter, companies like Federal Bank, who have a very, very strong Middle East remittance, sort of inflows from, they are actually raising very, very strong deposits because of the attractiveness of the deposit percentage. So give or take, it's between 6.4 to 6.7 percentage in terms of dollars, and this becomes a very, very attractive proposition for NRIs as well as for other investors sitting out in the world. What has that done? That has also lead to some bond yield sort of normalization from nearly 6.7% from a 5-year point of view to nearly 6.2%. So please understand this is very critical both from a liquidity point of view as well as an incremental cost point of view, because your currency was obviously losing its steam over the last 6 months in particular. And when we move ahead, we will talk about it in detail further. Moving to next. If you look at the currency, as I was saying, right, currency has lost, forget about, compared to China, but even compared to Vietnam and Bangladesh. Vietnam and Bangladesh are two very, very highly competing economies, which basically also has a region, sizable exports opportunity like textiles and other manufacturing, particularly electronics from Vietnam. The good news, I mean, the only silver lining here from this particular depreciation is obviously it becomes the exporters more competitive from an export point of view. But this time around, what has also happened is China has also allowed its currency, because China, please bear in mind, it's not a fully convertible currency or an open market currency, free float in that context. They've allowed the RMB to appreciate against INR by 15 percentage points. Just to give you a context, for the last 11 years, Chinese RMB to INR was in the range of between 11 to 11 and a half rupees. And now it's surpassed to 14 rupees, which basically means India's competitiveness compared to China has gone up multifold. Moreover, I think the export opportunity will be super strong for the next 12 to 18 months time frame, whether it's ancillaries, engineering goods, textiles, and other EMS players, which will see a flurry of opportunity in the next few sort of quarters to come by. Moving ahead to next, we have seen that in real terms also, for the first time in many, many years, China, competitiveness has gone significantly ahead of China. And as I was saying earlier as well, usually Indian currency compared to USD has depreciated, but obviously hasn't meaningful depreciated compared to yuan, which has not been the case earlier. And now, in our understanding, this basically helps the country to fight head on compared to most of the markets without any export incentive announced by the government of India. Moving ahead, what's what's another area of topic that discussion that we are all focusing on is the monsoon. So far, the monsoon and the showers are dry, but this is also an El Nino year that could obviously hit, be most likely the case could be. And in historical El Nino years, we have seen, in extreme cases, 20% deficit compared to long-term averages. But as per the IMD, sort of forecast, we think this time around, a 10 percentage is what the forecast is. The only and only submission to this point is, we could have a very, very erratic monsoon, which means, a dry June followed by a very, very strong July, and subsequently we could also see a different rainfall behavior in August and September. historically, whenever we had such dry spells of sort of monsoon, we have seen a very difficult, productivity in terms of key crop, which is rice, wheat, and cereals. This time around, I think the reservoir levels are at 10-year high. Also, the irrigation and canals are significantly better. So, the likelihood of that having a significant impact on the production is low. However, we will keep a close monitoring on this particular development because this is very critical for the rural economy, particularly in H2, to pick it up. Our understanding is after 3.5 years of very subdued rural economy between FY20 and 23, 24, 25, 26, this is the third consecutive year where the real wage growth will be far, far superior compared to the history. In fact, the real wage growth as per the RBI released data is positive 4.5%, which was last seen in before 2015. So there are all signs of green shoot recovery visible in the rural economy. The only, I would say, the joker in the pack could be a very, very poor monsoon, but the probability of very poor monsoon is remote as we speak, as on July, June 20, June 17th. Moving ahead to what's happening in the earnings. So as Bhargav alluded as well, all of our portfolios have delivered a very strong earning growth. But if you look at the broader indices, right, whether Nifty or you see BSE 500, earnings revenue growth has been in double digit even this particular quarter, similar to last quarter that we saw. However, the earning growth has been relatively muted, particularly in the Nifty because it's obviously a function of a couple of names which has reported losses. But overall, it's 4% growth for Nifty. X of those one-offs, I think the earning growth will be 9% in this quarter. And when you look at the broader market, which is NSE 500 or BSE 500, the growth will be in upwards of 14 to 15%. So I think the broad-based market earnings remains robust. The clouds of tariff as well as uncertain, US Iran, leading to commodity prices rally is behind. And I think earning growth will only get better every quarter and quarter, led by both consumption picking up because of GST intervention, currency getting arrested because of RBI intervention, as well as pro growth, intervention done by the government of India. So I think the earning growth cycle this particular year will only get better compared to what we started at the fiscal beginning of the fiscal year, because we thought, the crude, and we all were very confident that this particular US Iran conflict will end sooner than later, which is why the consensus believe that FY27, the earning growth will be in the range of 9 to 8 to 9 percentage. I think we'll be surprised to see the second half number in the strong double digit compared to low to high single digit that the most market is believing so. Coming from earnings to valuation, moving to next. Valuations continues to be below long-term averages, thanks to market obviously performance. So YTD, when I say YTD, calendar year till date, Nifty is down 10 odd percentage points. The mid and small cap are down between 5 and 0 percentage points. So the market hasn't delivered returns despite the earning delivering, both in Q4 and FY26 in positive sort of numbers. And we think the ROE obviously also tells a better story about improving trajectory. One more thing I would like to just highlight here, apart from ROE, when you look at the corporate profitability as a percentage of GDP is now at 5.6 percentage points, which is obviously, hitting the 2007 levels of to 5.6 percentage as well. So we are seeing the corporate profitability is now back to sort of, a peak efficiency when you look at the last 20 years of data point. So I would like to, sort of summarize in our view what we are seeing on the macro front. The big, question mark of crude is settled. Our view is currency will only get better because of interventions, and earning growth, in our opinion, will only get better thanks to both export opportunity picking up because of tariff clarity and domestic consumption remaining robust despite one-off issues with respect to inflation. In that backdrop, valuations have become even more attractive, and we think market is poised for a very strong and stupendous rally in the mid and small cap space for the foreseeable FY27, and will continue in 28 depending on various opportunity that opens up. With that, I would obviously like to comment my, sort of remarks, and I will hand over to the moderator for the Q&A session. Thank you.